Welcome to the end of 280 Cap E, IRS enforcement, transition rules, and what attorneys must know. My name is Philipp, chair of the BHBA Taxation Law section. The tax section is sponsored by Hochman, Sorkin, Toscher Perez. The Hochman, Sorkin, Toscher Perez advantage is experience, an eye for innovation, and a genuine dedication for clients, their families, and their business. In addition to their national practice in civil tax and criminal tax controversy and related litigation in federal and state courts, the firm is also active and successful in handling other non-tax white-collar investigations and prosecutions. And if you want to join our tax section every third Thursday of the month at 4 p.m., we are meeting. We are happily inviting you to meet us. And I'm delighted to introduce our speakers today, Annie Galyan and Jonathan Kalinske. Annie is the founder of Galyan Law. She is an attorney and certified tax specialist with the State Bar of California. In addition, Annie is a certified public accountant admitted to practice in California. She also holds the LLM. She was recognized as Southern California Super Lawyers Rising Stars in 16 through 2022. Annie has a knack for recognizing emerging industries and becoming a well-informed tax advisor to her clients within the specialty area. She focuses her practice in the area of tax law for federal, state, and local tax compliance, tax disputes, and tax crimes. She routinely represents U.S. taxpayers in civil tax examinations with sensitive tax issues. She has been in the forefront of representing cannabis operators in the state of California and all aspects of federal, state, and local tax compliance matters. Jonathan Kalinske is principal at Hochman Sorkin Toscher Perez and specializes in both civil and criminal tax controversies, as well as sensitive tax matters, including disclosures of previously undeclared interest in foreign financial accounts and assets, and provides tax advice to taxpayers and their advisors throughout the world. He handles both federal and state tax matters involving individuals, corporations, partnerships, limited liability companies, and trust estates. Annie, Jonathan, please take it away.
Philip, thank you for the introduction and welcome everyone. With the focus on changes in the cannabis space, we thought this would be a good presentation to talk about on the federal level, what is going on, and is really 280E rescheduling going to end 280E. So the focus of the presentation will be mostly on federal. We won't touch on state issues, and maybe in the future we'll have a state program on cannabis matters. But moving forward, just a disclaimer, whatever we say here is not to be taken as tax advice, and you should seek your own counsel with regards to your clients. Going to the next slide. Where are we now in cannabis? Cannabis was legalized going back to, the origins is 1973, just to give some background, when Oregon as the first state reduced penalties for small amounts of cannabis. Fast forward to the next level of legalization was California in 1996, when we saw a medical cannabis being allowed in the state of California. And then the next wave started the adult use legalization, which was 2012 with Washington and Colorado. And then California soon following in 2016. Since then, we've seen, if you can see on the map, legalization across various states on different levels, with only currently 4 states disallowing cannabis at all levels. But we see anywhere from adult legalization to medical legalization, as well as THC and CBD legalization for states such as Texas. Why this is significant is because we're starting to see a shift in public's approach to cannabis and also states' approach to cannabis, where individuals and citizens are not viewing this as a illegal activity, as well as states are looking for new sources of revenue in the form of excise tax and sales tax and other cannabis-related taxes. With the wave of shift towards the public opinion towards legalization, we are moving forward to rescheduling of cannabis. Next slide, please. Okay. So just a little history. Cannabis is a Schedule I narcotic or Schedule 1 product under the Controlled Substances Act, which says that there's no medical use for cannabis. Since that, 50 years has passed since scheduling of cannabis as a Schedule 1 substance. Now, with research and recommendations, cannabis has found to have medical use. And so we're starting to see a shift in pushing for rescheduling from Schedule 1 to Schedule 3 under the Controlled Substances Act. In 2023, the Department of Health and Human Services made the recommendation that cannabis should be rescheduled from Schedule 1 to Schedule 3 because there is a currently accepted medical use in the United States. Okay. We haven't seen any movement towards this rescheduling since that recommendation. There has been some movement with the Department of DEA with comments and whatnot, but nothing really has happened, and the industry is impatiently waiting to see the next steps. Next slide, please. And then we got great news in December of 2025. President Trump issued the executive order which says that cannabis should be rescheduled from Schedule 1 to Schedule 3, and this process should be expedited to move forward. However, this does not mean that cannabis has been rescheduled, does not mean that it is now controlled substances category 3. This is still a category 1. The industry has taken this as a shift in the industry. However, this does not elevate some of the issues that the industry still has with banking and Section 280E, which we will talk about momentarily. The next steps would be that the necessary steps have to be taken to make the rescheduling happen. This will move things along in the needle, but when it will happen, we don't know, and there's no current pathway of when that will happen. Next step.
Can I want to add over here just a quick comment is that I think anecdotally, at least listening to people in the industry, got very excited when this came out. But here we are 3-4 months later, and it really has been much ado about nothing to this point. And in terms of tax law, we're in the same space. Essentially, nothing has changed. This may or may not be an indication of things to come, but right now it's essentially fluff. And for those who are unwise and decide to take this as a direction to change the tax position on your return, I would just caution that and say you're asking for trouble.
Yeah, and the executive order is not just tax related. There are other implications with regards to research and banking, and this does not mean that these issues have been elevated or changed. We are still in the land that we were in before, and there are lawmakers who are against scheduling or rescheduling. So where this will go, we don't know. It is just that this has been issued and we are watching this closely, and it can have implications to how individuals or companies are doing their financials, modeling their financials, and also looking forward to the next steps in the industry. However, we're going to focus on how this will impact tax matters for our operators here in California and how they move forward in filing their income tax returns and classifying their activities under IRC Section 280E. So moving to the next slide. If you work in this space, you know that IRC 280E, oh, can we go back to the slide? Sorry. Thank you. IRC Section 280E is the law of the land right now, and it applies to Schedule 1 controlled substances, which cannabis is still classified under. What this section means is that operators can no longer take a deduction for their business expenses or credits. We just saw a recent case here in California out of San Diego ruling that cannabis operators are ineligible for the employment retention credit, which also comes under Section 280E. So it's important to keep in mind it's deductions as well as credits incurred in the trade or business. This does not include cost of goods sold. And the definition of cost of goods sold varies whether an operator is a retailer, licensed under the state as a retailer, or even certain distributors who are not adding any value and are deemed as a resale companies, and those operators who are holding cultivation licenses, manufacturing licenses, to some degree, some distributors who are adding value to the product. So you're either a retailer or you are a manufacturer distributor. And the way you compute your cost of goods sold will fall under those categories. So it's important to know what type of operator you are dealing with, what type of a license they hold, how they operate, how their expenses are spread out across the various departments. If you have an operator who holds a micro business license, which means an operator who can do all levels of activity here in the state, it's very important to know how to classify these expenses for Section 280E purposes, because it will come down on how the operators are computing their cost of goods sold if they're adhering to the 280E rules. I will say that some operators have put 280E aside and are taking the risk with operating and computing and filing their income tax returns without any regards to Section 280E. And I don't know if Jonathan wants to add any comment to that before we move on.
Yeah, I mean, I've had conversations with folks who take that position. I don't advise that position. I think it's problematic for a practitioner to advise that position. Even if your plan is to subsequently then challenge that position in court, I think advising on that position on a return that's being filed, whether you're signing the return or not, presents a problem. Several courts of different jurisdictions have addressed the legality of 280E, and to this point, it's the law of the land. It's been upheld. Certainly in tax court, it's been upheld several times. That's not to say tomorrow and the new challenges that are currently pending before several courts may not change things, but filing a return when with the plan of ignoring 280E, I think is asking for litigation. And I think those folks may say, yes, we know we're asking for litigation, bring it on. That's sort of the intention of some of these. But be that as it may, I think you are risking having your client face big tax liability, penalties, and potentially, depending on where you are positioned, you could face preparer penalties or different types of sanction in endorsing a position that may be considered at some points frivolous unless the rules change. So again, that doesn't mean we have to agree with the position and think it's right and just, but my view is that's the rule of the land, and until that changes, that's the way taxpayers should be filing their returns. That doesn't mean, and we'll get into this later, that if it creates a tax liability that your business can't pay, that there are no alternatives, okay? That you can't, knowing 280E exists, structure your business in such a way to minimize those effects. Just one example, you'll almost always see cannabis companies operate as a C corporation, because if there's going to be a tax liability, because of the effects of 280E, that liability sits at the corporate level instead of an S corporation, where liability would sit at the 1040 level and may put the assets of the individual owners at risk in a way that a C corporation doesn't. So there are other ways to address those issues, and just simply saying, yeah, we're going to take the position that 280E doesn't exist, I don't think is the right strategy, but to each their own.
Yeah. And I want to add that Section 280 does not just hit those licensed operators, it hits also unlicensed operators, but it also hits management companies who have been organized by operators, whether it's to get around 280E, banking, or just tax planning purposes. And we've seen courts take a strict rule that 280E does apply to management companies. So it's really important to consider what type of business your operators are in, how their choice of entity and how their business structure will be impacted by 280E. And we see in management companies that 280E, because they don't have cost of goods sold, pretty much taxes the operators at gross receipts level. There's no deductions allowed for those level of those companies. So moving on, what scheduling does change? Rescheduling is important for the industry because it will get rid of 280E. 280E will no longer be applicable. So this burden that cannabis operators being treated differently, being hit with is essentially a harsh penalty for being in this industry, will no longer be applicable. However, this does not mean that this also applies for past years. And we'll get a little bit into that when we speak about IRS collection. But 280E is moving forward as far as we know at the moment. We don't have any indication that it's going to be applied retroactively to prior years. It will let cannabis operators function just like any other business when they're doing, whether it's tax planning, financial planning, hopefully applying for banking, which we'll talk about in a little bit later. But it normalizes the industry without having this 280E burden imposed on them. Okay. Moving on to the next slide here. What it does not change is cannabis is still a regulated industry. It is still regulated by the states. It is still regulated by the federal government. It does not make cannabis legal for adult use across 50 states. It also does not eliminate 280E for past matters, right? So if you have past matters that you need to deal with, whether it's filing returns for past years or dealing with IRS collection for returns that have been filed, it does not await those issues, okay? IRS can continue to apply 280E in IRS audits. It can also apply, as far as we know right now, 280E in collection issues, unless that rule is changed in the Internal Revenue Manual. For states that do not have consistent compliance or consistent 280E application, this will also have implications for that. Here in California, the state of California, the conformity is no longer an issue with the federal government, so 280E is not an issue for cannabis operators here in this state, whether you're a corporation, an LLC, or an individual filing these returns. So it's important to keep in mind that rescheduling does not mean that now cannabis is legal and you can walk into any store and buy cannabis within your jurisdiction. Okay. With the change, I'm going to shift it over to Jonathan to speak on IRS examinations and how that's going to be impacted.
Thank you, Ani. So IRS examinations of cannabis companies have been around for many years. I would say that they've waxed and waned a little bit over those years. And I think we're currently in a period that if you look at IRS enforcement in general is down, staffing is down, and that's had an impact across the board. But we're still seeing cannabis companies at various levels of the industry being audited. And I would expect that to continue. I wouldn't say that there is an increase in cannabis audits at the moment. I think it's sort of been at a fairly steady level. As audits go up, those go up. As audits go down, those would go down. And we'll just have to wait and see with current staffing levels and enforcement at the IRS how things change into the future. And broadly speaking, enforcement, I think, is at a crossroads. And again, we'll just wait and see how things develop. So if you are unlucky enough to have a client be examined, you're going to have an initial audit letter, and usually that audit letter is going to be accompanied by an information document request. That information document request number one is generally a very broad request that is going to ask for books and records, copy of the return, copy of related any returns for related entities, W-2s, 1099s, sort of all third-party information reporting that has taken place. It's going to want general ledger. It may want various, a P&L. It may want an income statement. Sort of your basic documents, bank statements for one or all accounts that are there. It may ask for credit card statements if there's a credit card involved. Just depends. That IDR may seem very burdensome, but it's often a very typical IDR that you're going to see in any case. It's not generally an IDR that says you're in extra trouble because you're in the cannabis business. There are very much can be specifics that we'll get into because of cannabis, but that sort of initial broad-based IDR at the outset is what you see in almost every case. Some of the differences that you're going to see in a cannabis audit will be the agent's insistence early on that there be a tour of the facilities. And taking, for example, a retail shop, they're going to want to see the operation, because if you are claiming cost of goods sold and putting labor as a component to that cost of goods sold, but your shop is really just a retail floor selling product, that may be an issue. Okay, if you have a separate part of your facility that maybe only deals with the product and it's not your retail floor, that may be in your favor. But these are the things that the IRS wants to see, and coming out initially and saying, no, you can't come to my facility is not the way to start an audit out on the right foot in a very combative way. The other thing you'll see both in cannabis and in other businesses is the IRS is going to want that initial interview. Several years ago, through a FOIA request, the IRS released their training guide for cannabis audits and highlighted the importance of this initial interview and the importance of it being done early, because it said later on in the audit, people tend to hire a representative, and you'll get better information if you can get the interview done earlier before they hire. That obviously didn't sit well with the practitioner community, as well it shouldn't have. And that's a tactic that the IRS is using to try to trip up a taxpayer and get them to say things that a representative would advise them not to say, whether that's to invoke their Fifth Amendment rights or just to answer questions differently. That's not a practitioner trying to be difficult, but the take home here is if you have a client or you are the client and you get this audit letter, immediately talk to somebody like Ani or myself who handles these type of cases. Don't start going down the audit path and having an interview and only later saying, oh, geez, I wish I should have hired a representative. I kind of want to rewind and uh, uh, say things differently, because often it'll be too late. And if there are some real problems with the books and records, okay, that case may already be down a path for a fraud referral, or if things really go bad, a criminal referral. So at the very outset, once that audit letter is received, it's time to, I think, get a representative involved and plan the strategy. Okay. My preference is that the client is not going to be interviewed if I can help it. Okay. Sometimes you have no choice, but I'd like to postpone that interview for as long as possible. Okay. I can provide the information as far as documents go and have a discussion with the revenue agent. But oftentimes I don't want the client interviewed. I don't want the client put in the proverbial hot seat. But that's a case by case analysis that you're going to make with your client to have them understand the pros and cons of talking to the government. So all this again is going to happen fairly early in the audit. Once the audit gets rolling, I think, what the IRS is going to look at in a cannabis audit. Number one is cost of goods sold. Okay, have you shoved everything into cost of goods sold such that you're zeroing out the effects of 280E? I've seen it, and it becomes a problem, obviously. They're going to look at deductions if you are a cannabis touching entity, okay, and you should be abiding by 280E. Do you have deductions on your return that you should not have? Okay. One of the issues that I see increasingly, and this is a trickier one, okay, is does 280E apply to this business? Okay. Oftentimes in the structures, there are several different entities involved, some of which are sufficiently isolated that they really don't touch cannabis. Okay. I think the position can be taken that 280 does not apply to that business. Okay. This is a little different than what Ani was talking about earlier in terms of a management company. Often what you see in the management company is, let's just set up an S corporation, shove all the wages that we couldn't deduct, shove all the other expenses, and call it Management Inc., and then take deductions. Okay, that's tax court has heard that case. That case doesn't work. Okay, but when you have a separate entities that handle different aspects of a business, and some have nothing to do with cannabis. One may be, for example, a real estate related entity. Okay, I would argue 280 does not apply to that. Okay, so those issues I think are very much at the forefront. It's not always 280E, does it apply? Doesn't, did you deduct this, not that? It's looking at, does 280E even apply to this entity at the outset? And if it doesn't, you're just like any other business and you should be entitled to your deductions. One of the other things that is important here, but no different from a regular audit to cannabis, okay, is the IRS is going to issue a third-party contact letter. Okay, this is required. This has nothing to do with cannabis. It's required notice that if the IRS intends to contact third parties, they will issue taxpayer notice. Okay, and then you can follow up with the agent and ask who, in fact, has been contacted, if anybody. Okay. But again, these may be typically banks, okay? In cannabis, again, it's not going to be Bank of America, Wells Fargo, the big banks, but very well could be some of the credit unions and the sort of cannabis specialty banks that you see. very much contacted. They could contact your vendors. Okay, if you're retail, they could contact your the people who supply to you and do all kinds of third-party contacts. They could contact your employees, okay, and figure out what's going on. Again, the aim is, are your cost of goods sold accurately reported? Is your income accurately reported? Okay. But there's nothing that you are going to be able to do to stop the IRS from contacting third parties. You can know about it, but again, you're not going to have that ability to cut it off. Next slide, please.
I just want to add, so the examining agents who are coming out to cannabis operators for these exams, they're not just agents who deal with other industries and this is just a one-off case for them. These are agents who work within the cannabis unit. They have a technical advisor involved in these audits. So they know the reports that they're looking at. They know here in California, the metric report, the state reports, they want the sales tax returns, they want the excise tax returns, they want the business license renewal forms. They are coming in, they know what credit unions you may be banking with because they've been through this more than once, or they've had the technical advisor pointing to the right direction. So it's important to understand that you're not just dealing with an agent who is coming in and wants to tour the facility and it's the first time they're seeing a cannabis operator. Secondly, they're going to come in too. Sometimes during the interview, the technical advisor will also be on the call when they're interviewing your clients. So it's important to understand that you're not dealing with someone who doesn't know cannabis. On the flip side, we've had payroll audits where the examining agent does not understand cannabis and will make a comment, for example, why don't you use your personal banking to pay your payroll taxes, right? And it's like you don't understand how the industry is working. So just be advised of that, in that they're going to, for example, ask bank statements, but they're going to ask for not just for the entity's bank statements, but any bank statements that the company has control over, or the individuals with the company have control over, who may have commingled the funds. So then they can potentially expand their audit to related entities. So it's important to keep those informations in mind, and also important to understand how state reporting differs from federal reporting, so that you are better to explain to your examining agent why the sales tax returns, why the excise tax return gross receipts are different than what's being reported on the federal return.
No, thank you, Ani. Those are all fantastic points to keep in mind. And I think one of the other things to remember here is that the IRS, as Ani mentioned, they've been doing this for a long time on cannabis audits, and they've trained specialists to work here. And so I think initially at times, but I think it's gone away. And at least for me, it has, is there to be this tension like, oh, I'm in cannabis, I'm inherently in trouble. That's not true. Okay. If you're doing things the right way and your records match up, you'll get through the audit and you should be fine. Okay. It's when you have sloppy books and records, your POS system is a mess, your sales tax returns are a mess, and things don't reconcile, that you're going to have problems. Okay. But they're not after you simply because you're in cannabis. They are not going to refer you criminally because you're in cannabis. That's really never was the case with the IRS, and still is not the case. And so I think you need to have that level of cooperation with the agent to get through the audit, as opposed to a combative relationship. Okay, they know that this is a cannabis audit. Okay, whether 280E applies or not, this is a business who is in and around the cannabis space. Okay, it is not random. They're not asking the questions that they're going to ask because they just so happen to stumble on it. Okay, it's very much a targeted inquiry in the things that they're asking. Okay, so with that said, the other thing to note is if there are issues with the licensing, okay, uh, again, I don't know that the IRS is all that interested in whether you're black market, gray market, perfectly legal. Okay, you got to pay income tax. You've got a duty to report accurately. Okay, so that doesn't necessarily, there are other implications for that. Okay, that may change how you deal with it, but at a very basic level, okay, you've got to file your return. It's got to be accurate. Okay. One of the other things that I see very frequently in cannabis is oftentimes these are closely held businesses. There may be one owner, two, three, four, five owners. Okay. And there is a lot of use of personal funds going in and out, okay, or business funds being used for personal purposes. And that's where you can start to get into another layer of trouble where the maybe you don't pay yourself an appropriate salary, and you're driving fancy cars and buying fancy houses and taking fancy vacations. Okay, that introduces another potential issue of a constructive dividend or payroll tax issues, various things like that you see when you're commingling and sort of abusing the corporate form. But it is something you see all the time in closely held businesses, whether it's cannabis or not. I think cannabis adds the layer, oftentimes, of dealing with large amounts of cash that, in one sense, becomes a lot easier for the taxpayer to just simply use for personal purposes because it's not hitting a bank. Next slide, please. Some other items that may come up, we've already mentioned record keeping, ownership can be a contentious issue. You'll often see, for example, sometimes somebody's name is on the license, but they're sort of figurehead. Maybe they were just the person who was able to get that license easier or already had a license, but the business is actually being operated by other folks or another entity. That's one issue that can come up. I don't know, Ani, do you want to say anything about 471C?
Yeah, so 471C, some operators have taken the position that 471C is applicable and that they're going to start using this section to be able to allocate their expenses how it fits the business model, right? What is best suitable to represent the financials of the company as an accounting method. However, if the company did not elect to change their accounting method, that's an issue, right? If you're applying 471C. There are challenges to 471C, whether it's applicable, whether cannabis operators can use that to move cost of goods sold. For example, like some operators will take the position that the ability to sell requires that you have a license. A license will cost anywhere, it can be 120,000, for example, for an annual renewal for the state of California on average, right? And so they'll take the position that that is a cost of goods sold under 471C because it's indirect expenses for the ability to be able to sell. And so I'm going to put this as cost of goods sold. However, they did not make the proper accounting election, or they don't have the proper accounting method in place. And so that becomes an issue. These are being challenged in tax court right now. And so when we've spoken to the government or we've had conversations with the government, they do not comment on anything relating to 471C. Whereas we've seen clear application of Section 280E to cannabis operators by the courts. The other thing I want to add is, having been in the industry for quite some time, it's a misnomer that these operators are not banking. They are banking for the most part if they can afford it and they have the ability to obtain a bank account. But cash still remains king in the industry. And it's important to understand that cash accounting, making sure your records reconcile, you have accurate records, because at the end of the day, that's what's going to carry you through the audit. And so if your operators are paying for expenses and they're not documenting that properly and they're just estimating, you cannot rely on estimates. They need to have cash logs, they need to have receipt books, and they need to operate like any other cash business would have back in the day when cash was king. The other issue that we see is the ownership issue come up, particularly if you have an operator who is a social equity applicant. In the city of Los Angeles, social equity applicants are required to hold 51% ownership. So you have an individual holding 51% ownership, but then you have some sophisticated owner who's holding 49% through various entities and structures. And so when the IRS comes in, it's not very clear who the owner is. And the first person they go to is the individual whose name is on maybe the operating agreement or who's listed on the licensing. So that also becomes an issue, is because this social equity applicants, for the most part, are not sophisticated enough to get proper advice and probably protect themselves when it comes to these audits. Next slide. So outside of rescheduling is just one front of how we see changes in the industry and how we look to eliminate the application of Section 280E to cannabis operators. But there are cases that are also important to keep an eye on, as they are challenging the application of 280E to cannabis operators outside of rescheduling and the pending rescheduling that is potentially going to happen or not happen. Who knows, right? The most important case that if you're in this industry, you're watching is in New Mexico Top Organics, which is testing whether 280E applies to cannabis operators. So just like any other cannabis audit, cannabis business audit, the IRS went in and disallowed expenses outside of cost of goods sold, right? I mean, at this level of the case in tax court, they have agreed that cost of goods sold are deductible. The parties have stipulated to the amounts. So the only question is whether ordinary and operating expenses are subject to 280E. And so the case takes the position that Section 280E is no longer, or the petitioners in this case take the position that Section 280E is no longer applicable to cannabis operators because cannabis should no longer be a Scheduled 1 substance. And they go back to the history of when Schedule 1 was determined. There was no medical use, accepted medical use, and high abuse rate for cannabis. That has changed. That the criteria used to put cannabis into a Category 1 substance is no longer applicable. And therefore, based on the current recommendation and based on the current shift in the focus of how cannabis should be scheduled, the case takes the position that, or the petitioners take the position that this cannabis no longer falls within a Scheduled 1 substance and therefore should not be subject to 280E. And that's a new position. It's a unique position because we haven't seen that before. We've seen the arguments for various reasons why Section 280E is not applicable, but we have not seen the basis that, based on the current recommendation or the recommendation that cannabis be rescheduled, Schedule 1 no longer applies. And I think it's important to keep an eye out on this. If you're interested, there's a few amicus briefs filed on this case, and it's an interesting read. It goes through the history of cannabis and how it's being regulated. The other argument is that because it's no longer a Schedule 1, or it should no longer be Category Schedule 1, these are state operators subject to intrastate distribution, possession, and cultivation, and are no longer coming within the Commerce Clause based on the necessity that controlled substances overall scheme when Congress is going to apply this, right? And so this is the way that the case is shaking out. We'll see how it goes. It's in briefing right now, and we're keeping an eye out for it. If the case does move forward, or we've seen the tax court be very strict on how Section 280E applies, so it'll be an interesting decision to read. But in the event that you have operators who did not take a position that Section 280E, or took the position that Section 280E fully applies, there may be opportunities to file some protective claims or claims or refund, if there was tax paid. So we'll see how that goes. There's two other cases that are making its way through court that it may be important to watch. Both of these cases are filed by the same attorney. So they have similar positions in that 280 is no longer applicable because of the rescheduling that is on the horizon. The edible management versus commissioner, that's also challenging the operations of a management companies and whether management companies should be subject to Section 280E. The tax court has already ruled on this. There's cases on management companies that you can look up. And it's really important to keep in mind they're looking at control, they're looking at ownership, they're looking at whether the management company has other clients, right? Other operators that they're working with outside of cannabis. I'll give you an example. If you're a packaging company, for example, and you provide packaging to both cannabis operator and a non-cannabis operator, where do you draw the line of where 280E applies or not? And so a similar would be to management companies if you are truly a management company. But in cannabis space, when we look at management companies, it's generally the same owners. It's generally one entity that they're managing, or a group of entities, related entities that they're managing. And so this challenge, we don't see it going anywhere. And the tax court has been very strict on how 280E has been applied previously. So, Jonathan, you want to add anything on this case?
No, but
Okay. So next slide. So we talked a little bit about protective claims. I don't know if you want to add anything on protective claims.
only to say that the IRS came out and basically said these protective claims based on rescheduling are not valid claims. They're have strongly discouraged taxpayers from filing them. What I would say is, have that discussion with your client, whether it's beneficial to file these or not. Note that your claim has to be perfected at some point for it to be a full-fledged claim for refund. And you need to make all the requirements in terms of the year, the amount that you're seeking, so on and so forth. But this is a very real issue that there has been nothing in terms of retroactivity been mentioned. That doesn't mean it may not be something that gets put on the table at a later point, but the statute of limitations is going to be what it is going to be. One of the things, and this sort of gets into an issue on the next slide or two, is a lot of these companies really don't have money to pay tax and aren't paying any tax. And so there really wouldn't be anything to refund anyway. You can file an amended return that would eliminate a tax balance owed, okay, but as long and not seek an actual refund. To get a refund, presupposes that you have paid some tax that you would now like refunded. So a lot of these businesses are paying very little in tax. Not all of them. That doesn't mean that these aren't very applicable to certain businesses, or they aren't paying a little amount of tax because they just don't have the cash to full pay a liability. Then they file a return showing a very large balance owed, having paid some tax. That they may want back in a future year. So this is an important discussion to have with a client. You would not want to represent your client, never have this discussion, and now 2 years later they're saying, well, can I file a refund claim because 280E was ruled unconstitutional, something like that. Okay, so have that discussion, but know that the IRS is not going to act on these, and does not encourage these claims, quite the opposite. Next slide, please.
The one thing I would add is I agree with Jonathan that a lot of clients are not paying their tax. They're either taking a strong cost of goods sold deduction, which eliminates a lot of the tax. The returns that I've seen through audits show significant cost of goods sold, when in just view you can see that it's unrealistic, right? 99% of your expenses go to cost of goods sold. So they're not paying pretty much any tax that would allow them to have any claims. But also, when you're filing an amended return, some operators are taking the position, well, 280 is no longer applicable, so I'm going to file an amended return. Know that the amended returns will come under scrutiny, and they will be reviewed before they're processed, and that could sometimes lead to an examination as well. So, if your client is saying, I'm going to file an amended return to eliminate the taxes owed, they can potentially be under an examination at some point. So, okay, next slide.
Yeah, there's also issues with filing frivolous refund claims.
Yeah.
So if you irk the IRS, know that there could be consequences um, for your client. So shifting to, go ahead, Ani.
I was just going to say the government has a lot of information and a lot of data that they can pull from, and they know what percentage of the business generally is cash, what percentage of the business is credit cards or banking, how quickly these accounts get terminated. So don't doubt that the government's coming in blind-eyed and does not have the statistics for your industry, because they clearly at this point do. Cannabis has been legal since 2012. In Colorado and Washington. So there's a lot of data for them to pull from. Okay. Moving to IRS collection, it's great. The client filed compliant returns, applied 280E correctly. Now they're facing a huge liability, and the IRS is coming into collection. And with collections, I'm going to just focus on income tax collection, because payroll taxes have their own issues. Clients will sometimes use the IRS as their bank because they can't get banking, and then you have payroll tax collection issues, and that has its own nuances and issues, and that's outside of 280E and outside of this presentation. But here we're talking about income tax collection for tax returns filed. So that you start getting your notices for collection issues that are coming, a collection for self-reported taxes. What's happening? There's two avenues that operators can take when it comes to collection, right? It's hard for the government in this industry to do collection because banking is limited. They need to find the banks you're banking with, so it becomes kind of cumbersome, especially if your accounts keep getting terminated for levies, and then your operator can't get a bank account, and now they're forced into a cash function. We see the state of California coming in to do cash collection from the saves through a tap till, but we do not see the IRS doing that. So assets are hard to seize, cash is hard to seize, and so collection becomes an issue. But let's say your client is cooperating and wants to get into compliance and stop the notices from coming. There's two avenues to go through when it comes to collection, either an installment agreement or an offering compromise. With regards to an installment agreement, the IRS does not take into account 280E in determining the ability of the taxpayer to pay and the monthly income or monthly payment they can afford to pay. So they will take the financials just like any other installment agreement, review the financials, see what is available, and determine what can the client afford to pay on a monthly basis or quarterly basis, whatever you work it out with the government, right? Whereas on an offering compromise, the Internal Revenue Manual is very clear that when you're a cannabis operator who makes an offering compromise to compromise your liabilities, 280E is to be applied in determining your reasonable collection potential. And so that becomes an issue because when you apply 280E to the income, you have phantom income, you have phantom amount of available assets or future income that the government can collect from. So generally, offering compromises do not work out for cannabis operators, particularly for retailers and distributors who are facing large liabilities. And I'll let Jonathan talk about the Mission Organics case.
Yeah, so Mission Organics Center was a tax court case that challenged this offer and compromise aspect that Ani mentioned. I'm going to discuss this case because Ani is involved in this case. It's currently pending before the Ninth Circuit, and the tax court, in a divided opinion, and this is, what we call a court-reviewed opinion, where you have the majority opinion, then you have dissenting opinions, but essentially challenged this offer and compromise. And the court said, no, that's okay. It's not an abuse of discretion. And also, the court leaned on sort of policy that the IRS is within its right for public policy grounds to reject certain offers and compromise. And so we'll have to wait and see what the Ninth Circuit does with this case. But when it comes to the actual collection, and at the end of the day, the IRS should want to collect the taxes that it assesses. Its rigidity in the offer and compromise, I think, does not necessarily aid in its ability to collect some tax. The offer and compromise is designed to say, hey, we'll give some amount and the IRS forgives the rest. Oftentimes, the alternative is the IRS has to spend significant time and resources trying to collect an amount that may or may not be less than it would get having approved an offer and compromise. But the IRS to this point is going to stick by its position, which to this point has won. The other thing to seriously keep in mind on these liabilities from a taxpayer perspective is when you're looking at collection alternatives, specifically an offer and compromise, or you get into collection due process, you're tolling the statute of limitations on collection while that offer is pending, while you're in CDP, if you take that CDP to court. So oftentimes you're adding 2, 3, 4, 5 years to a collection statute, okay, where otherwise these taxes will roll off. Now, the negative to this is that as long as 280E is on the books, you're just going to start accruing new tax liabilities, excuse me, each and every year. And so if one falls off, the next year a new liability comes on. You're just in this pattern of always going to have some tax liability. But still, I think it's worth considering before you start doing collection alternatives or going to collection due process, what the benefit is, what is that doing to the statute of limitations, what are the possibilities that the government might go after the individual's assets personally, so on and so forth. So this is an area that is still developing. We will see how it turns out in the Ninth Circuit and any other future challenges. Next slide. So we're running out of time here. If you have any questions, please get them in. And I think the last thing we're going to have time to get to is 8300s. And this is an area that I think is often forgotten, but it is very important in cannabis. All your cannabis clients should know very much the ins and outs of the 8300. they're dealing in cash almost undoubtedly, no matter where on the cannabis business they are, they're coming into contact with cash. They're either paying cash, they're receiving cash, or both. And if it's over 10,000, they need to file an 8300. The 8300 form you can find a copy online. You should know it. Your clients should know it in and out. And each transaction should be triggering a separate 8300 for this. Okay. And the other few things to note, if somebody comes in one day with 7,500, says, well, I'll come back with another 7,500 the next day. No. That's not a way to get around the 8,300. That's still the same transaction. Most likely in an 8,300 would need to be filed. Clients will say, well, what do I do if I asked my vendor to give me the information so I can file an 8,300 and they would not give it to me. They didn't want to give their social security number. Can I still accept it and do business? The answer is there is a process to notify the government that an attempt was made to collect the information for the 8,300, and you would submit it to the government with essentially a statement as to what efforts you have made to collect the information. So simply saying, oh, well, I asked and that's it, they didn't want to give it to me, and go about your business, not the right answer. That's a way to get in trouble. And I think you do have to have the discussion with your client. If they have a vendor who absolutely refuses to give information, whether they should be doing business with that vendor. That's a consideration. And just to sort of put more dire consequences on this, not in the cannabis space, but a few months ago in the Central District, there was a case called Wynn involving a husband and wife and their precious metals business, where there was a conspiracy to avoid 8,300s were alleged. They were knowingly not filing 8,300s, receiving large amounts of cash, and they ultimately pled guilty to filing a false tax return and a conspiracy charge that included the 8,300 conduct. So this could turn criminal if you are taking large sums of cash and willfully failing to file 8,300s. And the penalties for this, even if they're just civil, really add up if you're doing high volume business. With that, I'll turn it back to Ani for any final comments. I thank everyone for listening to the presentation. And if you have any questions, please feel free to submit them, Ani.
Yeah, so I just want to add that, rescheduling does not change these requirements for the 8,300. These have been here before cannabis and are going to be here after cannabis too. And if you're even an attorney operating in this industry, you are required to comply with these rules, right? So it's something you have to keep in mind. Just a few takeaways, it's an industry to keep an eye out for. If you are operating in this industry, you're advising in this industry, even though things are moving slow, things also can move fast. So know your customers, know your clients, know what they're doing, and be on the lookout to see how rescheduling will impact your operators moving forward. Okay. We don't have any open questions, so we want to thank everyone for attending and turn it back over to the Beverly Hills Bar.
This concludes today's presentation. Thank you so much, Ani and Jonathan, for an excellent presentation, and thank you so much to our audience. Have a great day, everybody.